Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow, with our third quarter call. And I'll have to say that we see storm clouds forming that we haven't seen in the past 2 quarters. But if you want to see what we're thinking about right now, one of the things that's consensus on Wall Street, that no recession, everything's fine. We just think that's too complacent, that won't happen. The other thing is we're starting to see now true problems in commercial real estate and financing. We're starting to see foreclosures. We're starting to see properties go back to lenders. And consumers are really not in good shape. We'll say something about that later. But stocks to us, relative to what we see, are still overvalued. So if you look at the economy, one of the things we see is that pending home sales obviously have hit a new low. And if you put that in with the fact that the 30-year mortgage rate has hit a new high, and one of the things people tell us all the time is that, well, with a 3% mortgage, 3.5% mortgage, nobody's going to move. But they still have to make a payment. So if one of those loses their jobs, which we're not to that point yet, but one loses their job, they still have to pay for it, no matter what the rate is. And we think that's something that's going to be a problem no matter what. The last thing that's happening, you've noticed this a lot in gasoline prices, but obviously oil prices have been rising, and people don't realize that our supplies of oil are going down. And we put so much pressure on producers to go with green and everything else and I'm not trying to get into that here, I'm just trying to say that that's affected them quite a bit. And so our production needs to stay up with supply, and that's not where we are right now. I don't know how long it goes, but that's what we're seeing. The other thing we're seeing is bankruptcies. Bankruptcies starting to happen a lot now. We see more bankruptcies right now at any other time and this time of the year. And we think that they will continue as we go forward. And you'll know most of these companies on here, but there's more to come, I think, as you go along. If you look at the consumer, and this is just 1 month right here. This is month over month. My friend David Rosenberg gave me this information, but it's interesting, month over month. You'll see all of these are declining. And yet, if you watch the news or see somebody articulating that the consumer is fine, we just cannot believe that that's the right thing. The second thing is all of this money that was dished out in that 2.5-year period from the government, not the Fed, but from the government policies, and you'll see a lot of them here. They're all either ended in the last 6 months, they're ending now, and on top of that, you have a potential for a government shutdown. I know it won't last forever, but it causes problems, okay? And then secondly, you have the big UAW strike, but all of these things are taking money and things like that out of people's pockets. That's why the consumer, we think, is not doing that well. And one of the things that people say is, oh yeah, I go to the airports and go to restaurants, hotels, and people are traveling, they are spending money, but you're going to see how they're spending it in just a minute. One of the things we noticed, I know this sounds odd, but if you have utility being cut off at 12% of the population, you know, there's something wrong. That means they can't make the payment, much less make the payment for where they're living. The other problem we're seeing is credit card delinquencies have hit, a 12-year high. They're dragging on the cards. You'll see also, and this is an interesting point to make, credit card debt is obviously rising to new highs. Average credit card interest at over 22%, and people are still spending on those cards and raising the debt. And one of the things I noticed on my own American Express, but I don't have any, obviously I don't have any money borrowed on it, but interestingly enough, if you look at their annual percentage rate, 29.99, they didn't have the guts to say 30%, so we're going to use 29.99. But here's what's happening. We read about this a lot in the last 2 or 3 months, that people are just like, I can't make a down payment on a house. I don't want to buy another car. It's too expensive. You know what? I'm going to borrow some money or use what money I have, and we're just going to go have an experience, go have some fun, take a trip, whatever. That's why you're seeing that. That will end, though, when they run out of money, and I think that's closer than people think. From the standpoint of gold, one of the things about gold is that it suffers when bonds rates go higher. It's just they go hand in hand. Now, gold for the year is up in price. I know it doesn't feel that way because people will think, you know, gold is just getting hammered. And it's well down from the highs. Oh, no question about that. But it's one of those things that it's one of the very first things after recessions to come back. And we think there's a potential for that in here once you get to the other side of the river. So if you look at the bond markets, and this is the big problem right here, is that in the last 3 months, you've had the 30-year U.S. Treasury rate go up 25%. And everybody thought that would never happen. Rates were pretty much one and done. You know, that yeah, they could raise the short rates, but the long rates wouldn't go up. And when this started to happen, it changed the format of everything. It changed municipal bond trading, it changed Treasury trading, changed corporate bond trading, and people are like, man, I don't know here. And it gives that sort of effect. The last thing on the bonds I'll show you is something that we put in the market letter, which will be out toward the end of this week. And that is, if you look at, if you go back 3 years ago, okay, and you had $1 million and you put it out for 2 years, okay, you would get total $2,200 at the end of 2 years. You get your million back, yeah. Now, if you put it out, you'll get $102,000 is what you'll get. How about those numbers? I mean, it's incredible the changes that go on, but that's why people are like, you know what, I think I'll just hold pat for right now. So if you move on to the stock market, and I have to tell you, the speculative activity is still here. I mean, it's here big too. You look at one-day options, one-week options, throwing things around, buying these stocks that really don't make any money. But this comes out of Investors Daily that's in there almost every week. $100,000, if you want to trade weekly options, we could make you $8,000 to $10,000 a month. I want you to think about that just a minute and really think about, you think could you get 100, 120% return every year on doing something like this? But people fall for it, and that's where we are right now. The other thing that we notice, and this is interesting to us, is that the only group of people in the last 10 years that have increased their percentage that they put into stocks is people over 65. If you look now, they're putting 63% of their assets are in stocks, people over 65. If you go back, if you went back to 08, it was only 53%. So they've increased as they've gone along, even though they're closer to retirement or closer to a time they should be more conservative. And if you go back and look at Vanguard and Fidelity, they will tell you that in the 401ks, these people have a lot of money in stocks. They're not even thinking on their own. And so for us, that means something to us that that group is not afraid of anything. The other thing that's happened, and I would tell you to look at this, everybody's talking a bull market, bull market. We're not in a bull market. 2 years ago, the S&P 500 is exactly the same price it is today. Exactly. So you haven't made any money. If you own the index, you didn't make any money. Yeah, you know, it went down, then it went up, but still, you're dead even on where you are. We don't call that a bull market. Here's something you need to keep in mind. The bond market has been so bad and the stock market has been so good that you have these periods of, when you look at a 30-year return, that the stock market is completely opposite of where the bond market is. It doesn't last. We've got 3 times circled here for you. You'll look at 1987, you'll look at 1999, 2000, and you'll look at now. And one of two things happens, and sometimes both. Either the stock market comes way down, or the bond market rates go way down and they go the other way and they come together, or you get some of both, which wouldn't surprise us to happen as we go along. The other thing right now that's still out there, we're talking about this, is that if you look at the percent of market on the stocks that you see out there, the market cap of the S&P 500, the top 10 are 32%. Well, that means 10 stocks out of 500 account for 1/3 of the whole market. And if you'll notice, on the Russell 2000, which are the lower 2,000 stocks, 45% of those are not making any money. That is an unbelievable number, but it tells you where we are in the marketplace right now because nobody wants to admit it as we go along. So in summary, and I'll say this to you, if you look at the things that are out there, Wall Street would have you believe that everything is fine. Consumers strong, markets are okay, the Fed's going to come in and pivot. We're going, we'll be back in la-la land again. We just don't think that's the case. We see too many things today. We see foreclosures starting to happen with commercial real estate. We see apartments having to drop rents. We see people on all kinds of deals getting cash calls. That's the kind of thing you start to see when things are going bad. And it's just started. So it means that there's more of that to go because they can't deal with the higher interest rates. And obviously they're not coming down right now. So that's something we want to see. Go with quality right now. There's no reason for you to stretch into corporates or high yield or anything along that line because those are the things that will suffer as you go through slower economic times. And treasuries pay you a lot. So, we would certainly still recommend our largest holding is really the 90-day treasury and a floating rate concept, but it pays well. And we say maintain your defensive positions. I mean, you have plenty of time, and we've been in this, I just want to let you know, since December of 2021. We're almost 22 months into this thing, and we're still not in a bull market. So don't let them confuse you on this because that's the kind of thing you're into right now. And lastly, if we start to get some really tough markets where major declines or things are really coming apart and you have liquidity, if you would, try not to get scared of that. Use that as opportunity. That's where you'll really make the money. And I will tell you in advance, when that happens, it'll be hard for you to pull a trigger. Of course, that's what we're for. But that's the type of thing you have to go against the grain on when you get major sell-offs. And you could have more pain coming in. We think you really will have, over the course of the next 2 to 3 quarters. So with that, I want to thank you for watching and let you know that keeping balance in your portfolio is important. In a month, we'll have a new book out entitled A Balanced Portfolio. And we don't see a lot of people today with balance. They either have all real estate or all gold or all stocks or there's something. They're all private equity, but they don't have any balance. And we think that's going to be really important over the next 10 years. So if you need any information from that and any other information, come and visit us at our website, oxbowadvisors.com. Until the next time, we hope to see you again. Hello everyone, I just want to say if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe and you'll see more of what we do here at Oxbow.